Hey everyone, Daniel here from Next Level Life, and today I'm going to be tackling a big topic. Today I'm going to be examining traditional IRAs and Roth IRAs, trying to determine which one is actually better. Or at least just trying to figure out which one will be better for various situations, because as regular videos of this channel will know, my favorite answer of all time is, it depends. Because in the personal finance realm, a ton of your decisions will depend on your own specific situation, and that includes the answer to the question of which type of IRA is right for you. Now, I've noticed online that there's a lot of bits and pieces of information out there on the subject, but nowhere that I could find where you could really get a whole list of the differences in one place. So I'm going to make this video that place. In this video, I'm going to be going really in depth into the differences between the Roth IRA and the traditional IRA. But before I get into the differences between the two IRAs, I do want to briefly touch on the ways that they're both similar. Let's get started. Both the traditional and Roth IRAs can be contributed to by minors and non-working spouses, as long as they meet certain special income rules. The deadline for making contributions for both is April 15th. And under most circumstances, as long as you have enough earned income, the amount that you can contribute each year is $5,500 if you're under the age of 50, and $6,500 if you're over the age of 50. And earned income is basically wages, salaries, and tips in most cases. However, things like union strike benefits, or in some cases long-term disability benefits and self-employment income, can also be considered earned income by the IRS. But things like interest and dividends or Social Security or alimony or child support, those things are not considered to be earned income. I also want to take a moment to talk about modified adjusted gross income, because a lot of what I'm going to talk about later in the video won't make sense without it. So how do you find your modified adjusted gross income? It's really a two-part question, because in order to find your modified adjusted gross income, you first have to find your adjusted gross income. And your adjusted gross income, to put it simply, is basically your gross income, or the amount of money you make in a year, minus any deductions that you're able to take on your tax return, which can include IRA contributions, as well as student loan interest, tuition and fees, HSA contributions, and many other things besides. And once you've got that number, you have to add back in some of those deductions that you took out to get your adjusted gross income in order to find your modified adjusted gross income. Now, in many cases, in fact, in most cases, your adjusted gross income and your modified adjusted gross income will actually be identical. However, I'll put a few things up on the screen, and if you did deduct any of these things on your tax return, then you would need to add them back into your adjusted gross income in order to find your modified adjusted gross income. So with that out of the way, what are the differences between these two types of IRAs? The first thing that everyone brings up when talking about the differences between these two types of IRAs is the differences in tax treatment. In a traditional IRA, you can deduct some or even all of your contribution on your tax return, whereas with a Roth IRA, you can't. However, one thing that people often fail to mention when talking about the tax treatment of a traditional IRA is that while in most cases you can deduct the contribution, there are some exceptions to that rule. For example, if you're married and filing jointly on your tax return and your spouse is covered by a retirement plan at work, and as a couple, your modified adjusted gross income is more than $186,000 in 2017, but less than $196,000, you can only take a partial deduction on your tax return. And if your modified adjusted gross income is over $196,000, you can't actually take any deductions. And this is the case even if you yourself are not covered by the plan. Now, if you are the one that's covered by a retirement plan at work instead of your spouse, the rules are slightly different. If you're single or filing as head of the household and you make between $62,000 and $72,000 a year, you can claim a partial deduction. But if you make more than $72,000, then you can't claim any deductions for that year. If you're married filing jointly, or you're a qualifying widow or widower, then you can claim a full deduction as long as you make $99,000 a year or less. And if you make more than $99,000 but less than $119,000, then you can claim a partial deduction. And of course, anything more than that will stop you from claiming any deduction whatsoever, at least when it comes to the traditional IRA. And of course, you can't deduct your contribution at all for a Roth in just about any circumstance. That's really the heart of the difference between the two. Roth IRAs are taxed now, but can be pulled out tax-free later, whereas traditional IRAs is usually tax deferred now, but then it would be taxed later when you pull out the money. A couple of other differences between the two plans is the ages at which you can actually contribute. For a Roth IRA, you can contribute at any age. However, for a traditional IRA, you have to be under the age of 70 and a half in order to contribute. Another difference between the two is how much you can actually contribute. And I don't mean the contribution limits per year. Again, under normal circumstances, they're both the same, like I said before. No, I'm referring to some other contribution limits on the Roth IRAs specifically. You see, in 2017, if you're filing as single or head of the household and your modified adjusted gross income is more than $118,000 but less than $133,000, you can only contribute a reduced amount to your Roth IRA. And I will give you an example of how to calculate that here in just a second. And of course, if your modified adjusted gross income is over $133,000, then you can't contribute anything to your Roth IRA that year. And if you're married filing jointly, or a qualifying widow or widower, making between $186,000 and $196,000 a year will allow you to contribute a reduced amount, and anything above the $196,000 will stop you from contributing to a Roth altogether. That is, with one exception, known as the backdoor Roth IRA, which is basically where you contribute money to a traditional IRA, but then you convert it to a Roth. Now, in order to figure out how much you can contribute to a Roth IRA, assuming you're not going to use the backdoor method, I'm going to use an example. Let's say that Bob is a single, 45-year-old lawyer who's doing pretty darn well for himself with a modified adjusted gross income of $120,000 a year. As a result, he does fall in between the $118,000 and $133,000 limits for a reduced contribution to the Roth IRA. How does Bob figure out how much he can put in? First, he has to start with his modified adjusted gross income. And then, because he's filing as a single, he must subtract $118,000 from that modified adjusted gross income. And for the record, it would be $186,000 that you'd take away if you were married filing jointly. This leaves him with $2,000 left over. He must then take that and divide it by 15,000, or 10,000 if he were married filing jointly. Why? I don't know, it's just how the law works. But that leaves him with 0.133333 and so on. He must then take that and multiply it by his contribution limit, which, since he's 45 years old, would be $5,500. Of course, if he were over 50, it would be $6,500. But he's not, so 0.133 times 5,500 leaves Bob with $733.33. Then the last step for Bob is to take his contribution limit of $5,500 and subtract that $733.33. This leaves him with his reduced contribution limit for the year of $4,766.67. The next difference between the two types of IRAs is penalties. If you have a Roth IRA, then you won't pay any penalties for withdrawals that are taken before the age of 59 and a half, as long as those withdrawals are not more than the total amount you've contributed yourself to the IRA. So say if Bob from earlier had invested $5,500 a year into his IRA for the last 10 years, he would have contributed a total of $55,000, and he could then take up to that $55,000 out without incurring any penalties. However, if he took any more than that, he would be hit with a 10% federal penalty tax on the withdrawal of his earnings in the IRA. So say he had a few huge medical bills and he had to withdraw $60,000 from his Roth IRA, he wouldn't get penalized on that first $55,000 because that's what he actually put in with his contributions. However, on the last $5,000, he'd be hit with a 10% penalty, which would be worth $500. Whereas in a traditional IRA, there's a 10% penalty on withdrawals of both your contributions and your earnings before the age of 59 and a half. So if someone were to take that same $60,000 out of a traditional IRA, they'd be taxed on 10% of the whole $60,000, or $6,000, which is quite a big difference if you have to take stuff out of your IRA. But of course, it's finance, so there's always an exception, and in this case, your withdrawals may not be subject to the penalty tax if it's due to any of the following reasons that you see on your screen. Yeah, finance laws are unnecessarily complicated sometimes. The next difference between the two types of IRAs is that the Roth IRA has no required minimum distributions, but you must take a certain amount of money out of your traditional IRA starting on April 1st of the year following the year you reach 70 and a half. So if your 70th birthday is, say, on May 20th, then you will be 70 and a half years old in November of that year, meaning that you would need to take a required minimum distribution from your IRA the following April 1st. And then every year after that, you need to take it by December 31st. Why? Again, I don't know. It's just how the law works. The amount of the required minimum distribution varies depending on your life expectancy, so you'll have to consult with a financial professional to figure that one out. And the last thing that I want to talk about is inherited IRAs. Now, there are 3 ways to inherit an IRA if you're the account owner's surviving spouse. You can either do what they call assume the IRA, as long as you're the only beneficiary on the account, that is. And basically how the IRS treats it if you choose to assume the IRA is they assume that the IRA you received was yours all along, which means that you can add your own contributions to it, and if it's a traditional IRA, you won't have to take any required minimum distributions until the year after you turn 70 and a half like we just discussed. The second option is to inherit the IRA, which could have been named better. I mean, come on, why is it that if you inherit an IRA, inheriting the IRA is a term used for one of your 3 options? They could have made that clearer. Anyway, inheriting an IRA basically means that you're going to transfer the amount in the IRA you received into a different IRA that's in your name. Now, if you do this, you will have to begin taking a required minimum distribution in the year following the previous IRA owner's death, which can be good if your spouse needs money right away, but it also means that the IRA won't grow quite as much because you're no longer able to just keep letting it appreciate. The third and final option is to disclaim the IRA, which basically means you just refuse to accept it, either in part or in full. But you're gonna really want to fully think that through, because usually when you disclaim an IRA, you can't change your mind later. It's just gone. Now, if you're not the account owner's surviving spouse, you can still either inherit or disclaim the IRA. However, if you choose to inherit it, you must start taking those required minimum distributions right when you inherit it, instead of the year after. But that'll just about do it for me. I hope you enjoyed the video, and if you did, or if you learned something, be sure to like and subscribe. I've got a lot more of these finance videos coming out in the near future, as well as some more book summaries and some other fun stuff coming up on the channel. Also, if you have any more questions about IRAs, be sure to leave them in the comments, and I will do my best to answer them. But with that being said, thanks for watching, and have a great day.